Well, thank you for joining me today. My name is Marc Montini. My company is the Montini and Company Tax Advisory Group. And on this short webinar today, we're going to talk about the power of the Roth IRA. Just real briefly about us, we are a tax and financial planning firm. We are a one-stop shop for your retirement planning needs. If you've ever worked with a financial advisor, you know the advisor typically doesn't understand the tax. If you ever worked with a CPA, you know that CPA typically doesn't understand the money. So here, we're bringing both of those worlds together. We are a one-stop shop, and we firmly believe that tax and retirement planning go hand in hand, and you can't do one without the other. I am a licensed fiduciary, which means that when I am doing financial planning for my clients, I have a legal obligation that those recommendations are being made in their best interest. I've been in financial services now for almost 30 years. And what we really specialize in as a company is tax reduction strategies. Again, if you're going to really maximize your retirement, the way you're going to do it is through tax. We do a lot of income planning. I've learned over the years that for a lot of people, the idea of retirement can be a little bit scary. So when we have a written income plan in place where you can see where your money's coming from, you know that it's sustainable and that it's being taken in the most tax efficient manner possible, it can alleviate a lot of the fears that you may have. As I said, for the financial planning side, we do manage assets, but we also do taxes. That's part of our tax side. Our tax returns start at 175 and they go up very modestly from there. With the new bill that Congress just passed with 87,000 new IRS agents coming on board, it may be best to have a pro to start doing your taxes for you. So when it comes to tax season, please remember us. So what we're going to be talking about today is obviously the power of the Roth IRA. But in order to really understand that, we have to understand the taxation of your Social Security. So how much tax you're going to be paying on your Social Security is a function of the income you have other than Social Security. So what is that other income? That's taxable interest, that's dividend income, that's capital gains income, that's traditional IRA distributions, that's tax-free municipal bond income. All of this is income other than Social Security. Now, how much of that you have is going to dictate how much of your Social Security is going to be taxed. So if you're filing as a single, okay, and your other income is less than $25,000, then none of your Social Security is going to get taxed. If you're filing as a married couple and your other income is under $32,000, then again, none of your Social Security is going to get taxed. But if you're married and your other income is between $32,000 and $44,000, you're going to have half of your Social Security become taxable. If that other income, if you're married, that other income exceeds $44,000, then you're going to have 85% of your benefits get taxed. So let me change screens here just for a brief moment. And I'll show you exactly what that's going to look like. Okay, so what we're looking at here is a federal Form 1040, basically a summary of your entire tax return. But as we scroll down here, okay, let's say you have traditional IRA distributions of $40,000, okay? That $40,000 moves from 4A and becomes taxable in 4B. Now, let's say you're married and you have combined Social Security benefits of $40,000 as well. So that's $80,000 total. Well, because your other income is between $32,000 and $44,000, you're going to have half of your Social Security move over and become taxable. Okay, so you had $80,000 in total income, but your taxable income is now $60,000. But let's change the story just a little bit. Let's say you have traditional IRA distributions of $20,000 and Roth IRA distributions of $20,000. Now, only the traditional IRA moves over and is taxable. The Roth IRA does not move over because it is not taxed. So your $40,000 in Social Security, because that other income now is only $20,000, because that's less than $32,000, none of your Social Security is going to get taxed. So now your total income, taxable income, is only $20,000. But keep going. Your standard deduction is $25,000. That's going to wipe out all of your reportable taxable income. Look who's living tax-free. So let's keep going here. I got more examples that I'm going to show you. Okay, now when it comes to the Roth IRA, how do you fund a Roth IRA? Well, there's two ways to fund it. You can fund it through a conversion, or you can fund it through a contribution. If we're going to fund it through a conversion, there's some benefits on doing that. And what a conversion is, we're systematically converting the traditional IRA into the Roth. Now, the good part about conversions is that there are no income limits on it. You can make as much as you want, and you can convert any dollar amount that you want. So for higher earners who may not have been able to contribute to a Roth IRA, this could potentially be a good way to start to build up that Roth IRA. Basically, when we do a conversion, what we're doing is we're paying the tax now so that we can have tax-free growth and distributions in the future. Now, the other way to fund it is through contributions. Now, contributing, you can only contribute $7,000 a year. And be it that my client base are baby boomers, and I typically only have, about 3 years or so to work with them before they retire, we can't contribute enough to build it up to a sizable enough asset that we can take a meaningful supplemental income from. So I don't do a lot with contributions, but I do a ton with conversions. Now, when it comes to a conversion, as I said, we are going to be paying the tax now so that we can get these tax-free distributions and growth in the future. So because we're paying the tax now, it's a taxable event, so we have to be very cautious on how we actually do this conversion. And what we do here in our office is we look at your taxes, and we look at where your current taxable income is. Then we look at where the next tax bracket is, okay? And we're typically only going to convert from where your taxable income now is to where that next tax bracket is. That way you're paying the same percentage of tax, but you're not paying an excessive amount of tax. Here's another example. So this particular client of mine, he was leaving a job where he was offered a pension. And when he was leaving, he had two options. He could either take the annuity payments from the pension, or he could roll the lump sum into a traditional IRA. So when we were trying to figure out what the best route to go was, I said, well, let's look at it from a tax standpoint. Okay, so if he took the annuity payments between his pension and his wife's pension, his wife was a government employee, so she had a small pension as well, they would have $94,000 in income. All of that moves over and is taxable. Their combined Social Security is $41,000. Well, because their other income exceeded $44,000, 85% moves over and is taxable. That puts their total income at $129,000. Now, at the time that I did this, the standard deduction was 24 grand. I brought their income down to 105. Tax due on that's about $23,000. Okay, not bad. You got 130,000 in guaranteed income for the rest of your life. Pay your taxes, it's okay. But what if we just took a little extra step and looked beyond and said, well, what if we took the lump sum, we rolled it into a traditional IRA, then we systematically converted it into a Roth so that we can take a supplemental income that would meet what he would have gotten from the annuity payments. Here's how that looked. So we got the same $94,000 in income between him and his wife, but this time only her pension moves over because his distributions were all Roth. So because that other income is under $32,000, none of the Social Security is going to move over and become taxable. So that puts her taxable income at $14,000. Standard deduction of 24 grand wipes it all out. Again, look who's living tax-free. Just takes a little bit of time and planning, but we can do this kind of stuff. Another benefit of being in a Roth IRA is a Roth IRA is not subject to required minimum distributions. What required minimum distributions are, or RMDs, is at age 72, the federal government is going to require you to start taking distributions from your qualified plans, your traditional IRA. Okay. And the distributions that you're required to take starts at 3.64%, and each year it builds and it gets bigger and bigger and bigger. Now, if you don't take the distribution, the penalty is 50% of what the distribution was supposed to be. So in my example here, we got $500,000. The required distribution was 5.34%. That puts a distribution of $26,000. If we don't take it, the penalty is going to be $13,000. Now, more problematic than that is that by the time you're 72, hopefully you are retired, okay? And hopefully you are living tax-free. But now at 72, now you've got all this additional income you don't want, you don't need, that's going to completely disrupt your income and tax plan. So that's yet another reason why we want to look at getting your traditional IRA converted into the Roth. Now, where do we go from here? If you liked this content, if you thought it was helpful for you, then join my full 57-minute class that I teach every Thursday night at 6 o'clock. You can register for that class at phoenixsocialsecurityclass.com. That is phoenixsocialsecurityclass.com. As you can guess, we do talk a lot about Social Security. We also will talk about the Roth. We'll talk a lot about income planning. We'll talk about different places where different investment options that you may not have considered. But it's a 57-minute class that I do think that you'll enjoy. And if you like it and you enjoy this content, please share this with your friends and family. And with that, thank you very much. I hope you enjoyed this, and hopefully we look forward to seeing and meeting you in the future.